Hi, good morning everyone. We're going to start our morning call, our 11:15 webinar right now. Hope everyone's doing well today. Okay. Uh, okay, we'll just do a brief market analysis. So just to recap on gold, this was the gold chart last week, and we noted basically that yes, even though we broke through this support, so we expect further downside, we did expect that there will be a short-term bounce potential. Okay. Um, okay, at the support over here at 120. So based on this week, you notice that there was a bounce indeed, and and the price conveniently had a sharp bounce but got rejected at the last support. Okay, so overall we have a bearish bias long term, but on the short term we do have to see whether it can break up and go back into the channel, or whether it will actually fall below its bottom over here. And of course, if that major support is broken at 1210, that actually implies a technical move to 1000. Whether or not it actually goes there is anyone's guess, but technically speaking, just based on technical analysis, that actually is the price target. So now is probably a very crucial time for gold, and we have to keep our eyes on the price right now. If the price does break back above this resistance here, okay, if it at 1280, then basically the price target will be basically within this range, this channel over here. Note, even with this bounce, once again, we still see continued weakness in the gold miners. Hence, we continue to be have a bearish bias. Okay, for the S&P. So right now, as we noted from last week, that the price was actually flirting technically on the upper limit of the greater channel. So to us, to at least for a technical point of view, there is no surprise that price would basically bounce below this, because you essentially need very, very good news or something very significant to break through a historical channel like this. And so since there is still some jitters, no surprise that there has been a correction downwards here. So right now we are consolidating within this bluish zone which I denoted over here. Although the price seemed to break below it, but when it comes to markets, you have to give and take a bit. So to me, this is a consolidation over here. So a consolidation like this usually implies favors a one more move downwards like this. And if that does happen, then this is essentially the price target over here. This 1772 zone over here. Okay. At this point, breadth is still weak, as denoted by the McLennan oscillator. But we're going to talk about something interesting though. There's a possibility at the later half of this month, December, there could be a short-term move up or Santa Claus rally, and if that coincides with the price reaching this zone, then that might be a good high probability short-term rally move. Okay, so let's go on further. Okay, so here's some statistics for you. Over here is basically for the last 20 years, 1994 to 2015. This would be like the seasonal performance of the S&P. So at the bottom shows you the average percentage increase for each month. Okay, and then on top here gives you the percentage of the time which that month actually closed higher. So as you can see, for the last 20 years, 70% of the time, December closed higher, and the gain is on the upper side of 1.5%. So we compare it to essentially the other gains here for the rest of the months. So December has a tendency to be stronger than usual, and this for the S&P. Now, more importantly, the Russell, which is a measure of small caps, which are more sensitive economics-wise, it has even stronger performance. You'll see that on the last month, December, right, 85% of the time there is outperformance, and the net gain is 3.3%, which is actually higher than the rest. So for the S&P and for Russell, December has a high tendency to be a stronger performance. Now, of course, this is no guarantee that this particular year, this particular month will follow suit. But at times where market news is agnostic, or there is no clear trend in where to go, that's the best time actually to look at technical analysis and statistics as well to put the odds in your favor. So you might have noted that this December started off very weak. Okay, but according to certain analysts, okay, Sanovsky over here, Sazanovsky, he does note that the Santa Claus rally typically runs from December 16th to 26th, and that the first 2 weeks of December usually is typically soft because of tax-related selling in the US. So the first 2 weeks of the year of December that was weak was not untypical, and it's interesting. So the Santa Claus rally could occur in the last 1 or 2 weeks of the year. Now, taking into account these seasonal tendencies and the current state of the stock market, next week could be interesting for swing traders. Okay, because we note once again that this zone here will be a very major support. Okay, if it reaches there, and that will coincide with the probability of having a year-end rally. Okay, so I put this down so no one is surprised if it rally does actually happen, because statistically it's in your favor. All right, so that's for S&P. Sector glances here, just for your reference. Okay. Once more, on the longer term, we do note that the offensive sectors are still in an uptrend. See, the industrials, as you can see, relative strength is still on an uptrend. Cyclicals, industrials on an uptrend. Okay. Utilities is on a clear downtrend for the last 6 months, very clear. And materials is correcting, and energy is correcting. See, they're not on downtrends; they're more sideways trends. Yeah, so this tells you essentially where we think we still are on the business cycle, stage 4 and stage 5. So even though a correction can come, but the cyclical bull market is still on. Intermarket relationships, as we noted from last week, we said that the probability of the price getting back to this support line was extremely high, and indeed for the last 2 weeks, that's exactly what happened. Price basically had corrected all the way back down to this long-term uptrend line. So once again, we do need to look at this, okay? Because if this line actually breaks, then technically speaking, we have to say that this is the first sign of a reversal in long-term trend. Okay, prior to this, we can't say that because this line has not been broken. All we did see was a big sell-off here, which we suspect could have been the first move of a bear market for bonds, which is what we have been alluding to for the past few weeks and months. Actually, I mean, if you subscribe to this chart over here, oops, not this one. If you subscribe to this chart over here, which we said we are here, right? We already denoted that bonds was already on its first move of bearishness here. Okay, so indeed, if this price breaks down from here, that will confirm that indeed this move here was actually the start of a long-term downtrend. Okay, so we have to keep our eyes peeled on the bond prices over here. Okay, similarly, stocks is still on an uptrend despite this correction over here, right? We don't really have to worry technically wise unless price actually breaks the most recent resistance break, which is here. This is where the all-time high was broken. So this correction is basically what we call natural. So until price actually breaks through this level here, then we start to worry. Okay, commodities are essentially behaving what we think it is. If we are correct and we are on the stage 4, stage 5 of the business cycle, then that will correspond to commodities having to consolidate and breaking out as bonds comes down. That's the typical behavior intermarket-wise at this point of the cycle. But of course, technically speaking, bonds is still in an uptrend because this line's not broken, and industrial commodities are still on a downtrend until this line is broken. Oil service sector. Okay, so we told you that stop loss at 49, right? Because the probability of it going below is high based on the technical pattern, and as you can see, price is slowly drifting down. So once again, we reiterate that when price gets back down to 45, 46, which is what we noted here, then that would probably be a good risk reward for short-term trading if you get back to this point here. Okay. So to reiterate, phase 4, this is where we think we still are. Okay, for China, we see basically that we are consolidating after the first sign of breakout. So right now, price has basically broken through this long-term multi-year downtrend line over here, and that is good if you believe that this is a double bottom. Okay, right now price is consolidating over here. This consolidation at this point is still natural because, as you notice, right, the rejection over here, right, occurred right at this big resistance level over here, which is your cup and handle bottom over here. So this rejection is actually natural. The key is, are we going to consolidate and go up? And that's what we're looking for. But as for now, we did have our first sign of breakout, which is good. And we continue to look at this price to see whether it can confirm the breakout. Now, if the price actually breaks above this this high over here at 2260, if it does, that actually implies an upside all the way up to between 240 and 2500, and that's the short-term price target. STI, okay, we know once again from last week. We noted that most likely the price is going to head down to this level here, which was the 3025, which we talked about last week, and price indeed went to 3025, and as you can see, there was a big rejection on the week itself. Okay, so we did have our short bounce. The question now is we need to see whether price can be strong enough to consolidate and go up, or whether price will actually eventually break down this level over here, this support level. If price actually breaks down this level at 3025, sorry, that implies actually downside to 2910. Okay, roughly here, short-term downside target. Okay, but as long as price does not break through this support line, then we expect upside bias. Okay, now just to give some historical context as well, I did the same analysis to the STI, the seasonality chart, and so for the last 20 years, from 1994 to 2013, we also note that December for the STI has also been a historically stronger month. Okay, in terms, yeah, so 70% of the time, December has been a positive month, and this is the average gain in December. So it's relatively stronger than most of the rest of the months. Okay, it only falls short of April being the highest, basically. Okay, and so let's keep our eyes peeled. So we have this December statistical outperformance going on, and we are basically at the support line. So that gives us two reasons to basically keep our eyes peeled here. Okay, might be good for swing trading. Okay, but we need to make sure that price does not break through the support. Okay, if it does, then I reiterate, it will imply a further downside to at least 2910 if this breaks. Okay, and I think that's it for the market analysis. And now I'll bring you to Lucas Tan, who will talk to you about the property sector outlook.
Yep. Hi. Good morning to all. Yep. I'll bring you guys through the sector outlook for property 2014, and also mainly I'll just highlight the themes that you guys should look out for, and also the what we are actually I think what are the main issues in the year ahead. For residential, over the past 4 years, there's a total of 8 cooling measures up to date. In this slide, I have sort of summarized what's the current day, what are the policies that is in effect after the numerous adjustment. The key highlight is the most recent TDSR at 60%. This sort of ties in all the previous 7 cooling measures and sort of hits both buyers, sellers, and also the financing, source of financing. So it's kind of like, it's from here onwards, we believe that it's going to be more of such policies. It'll be fine-tuning, just making sure that no one step off the line. So, yep, this is a summary. All right, 3 months ago, okay, this is our outlook. We have noted that the number of units sold are a result of carry-through momentum of prior launches, and that in this 4Q, you'll witness actually much weaker transactional sales volume. 3 months forward to as of today, you can see that in the last 4 to 5 months, the transaction volume actually came down quite a fair bit. So yeah, it's in accordance to our forecast. So what do we expect in 2014? The first one is actually that we believe that there will be another round of cooling measures, but this time going forward is more of fine-tuning. There will not be any more drastic changes to the fundamentals. And also just last week, the minister actually came out to say that current prices seems to be kind of in line, and he do not expect any greater changes going forward. The number of transactions is decreasing and should remain so. This is like more of a premonition of the price coming down. In the next few slides, you can see that actually the residential price kind of holds stagnant. It did not really drop drastically, or in a sense that there was not much of a correction. So we believe that the transaction will remain low until the price correct. Going forward, there will also be an oversupply. We are estimating about 170,000 residential units over the next 3 years. However, demand is about maybe 60 or 70,000 in terms of occupant demand. So the remaining demand can either be as of the investment capital, or maybe the market will suddenly have a certain trend whereby there's lesser individuals within each house. So in that sense, boosting the demand for residential units. But we do not really think that that will really be the case, mainly because of affordability and also because of the very low rental use for investors currently. This will be further elaborated on the next slide. So yep, oversupply situation. You can see that rental value is still high. Capital value is also maintained at current levels. So if you allow me to go to the next slide, you can see that for the net property yield, it's still kind of at about 4.5. And in terms of what's actually happening on the ground, it's maybe like about 1.2% in terms of residential property yield. So that's really, really low. If you comparing the island-wide residential net property yield, is about 1% only as compared to this net property yield, because it's just the basket of goods doesn't really capture the whole situation. In terms of the top right-hand side, you can actually look at the upcoming supply. As per illustrated, as I was saying just now, that supply will outstrip demand. So in this sense, in this case, okay, there may be you may start to see developers pushing back their launches, delaying their launches, or refiling their forms to say that they will only launch at a later date, because over the next 3 years we don't see occupant demand really supporting the case for such a high amount of supply. If they were to go and push ahead with this, there will be a lot of inventory units, in other words, unsold units, and you can see that the property price will actually correct quite a fair bit. But we do not expect that to be the case. We expect developers to hold back again and wait for supply to actually catch up. All right. So just before we move on to retail, there's a recap with oversupply, and also there's be policy risk in the residential segment. So the bright spot for real estate sector will actually be retail and hospitality. For retail, the same fundamental still stays. We still expect the low unemployment and moderate inflation to continue for Singapore, and that will translate into strong purchasing powers for in terms of domestic consumers. So we believe that retail sales growth will still be positive for 2014, and the next point will actually be that tourism play will remains intact. We still expect the STB estimates to come through, which will be about 6 to 8% annual growth in terms of arrivals, and also in terms of tourist spending for the upcoming 2 to 3 years. Yep. So we can see that although there's a huge amount of supply coming up, or rather, in fact, 2 malls have recently just opened, so that will actually form quite a big part of the supply too. But based on strong fundamentals, and also can be evidenced by the fact that these 2 most recently opened malls are actually 100% pre-leased. So they are supported by strong fundamentals, and we expect this subsector to hold up. This is a summary. Rental values is currently still holding steady at the current high rates. Capital value is showing a slight increase. Vacancy, well, it will most probably hover below sub 10% for year 2014. We don't see any reason for this situation to change. In terms of upcoming supply 2014, currently the data doesn't actually capture the opening of the most recent 2 malls, one in the West Jurong and the other one in Bedok in the East. So including those 2, you can see that the supply will actually for 2014 be dropping to sub 100,000 square meters. Going forward, we believe that this upcoming supply will also see very strong pre-commitment levels, and for the rest of 2015-16, we actually don't see any upcoming supply in that sense. So this slide actually shows whatever is upcoming, where you can see that the first line, these are ones with the expected year of completion. As for this slide, the next slide, this is actually our estimates for those that is as in those malls that is not really having any expected TOP year. Yep, so these are our estimates, right? When we actually talk to developers and also talk to leasing agents on the ground, and we are able to form this estimate as well. So this is kind of like a comprehensive summary of upcoming retail. Yep, to look out for. Okay, hotels, the story remains the same. For tourist arrivals, you look at about 4 to 6% growth over the next 5 years, and for tourism receipt, you'll be expecting about 6 to 8%. As the Singapore Tourism Board is remaining very active in this front, you can see them coming out with numerous initiatives to try to promote this subsector. Okay, so our recommendations, basically, to focus on prime retail and hospitality, and to also focus on stocks whereby there is very strong growth opportunities in terms of your asset base or in terms of organic, in terms of like going through AEIs and whatnot. So actually avoid those that have very high gearing, and also try to look for, if you're looking for those counters with very strong asset base, look for those that already have their interest rates hedges in place. For the developers, we continue to favor CapitaLand and CapitaLand over CDL. And the main reason is because CDL is largely exposed to the local residential market, and about 45 to about 48% of their gross asset value is actually located within Singapore residential. We do expect some delay in launches in terms of cash flow. CDL will you can actually see a slower year ahead for them as they try to reinvent themselves, try to diversify into other business. As for CapitaLand, the reason why we favor it is because it's really at the bottom of valuation. But having said that, we do acknowledge the fact that this sector outlook is kind of weak for the year 2014. There may be a lack of impetus for the share price to move. So the key points to look out for is actually the interest rates and also the policy fronts. Should do these two danger points actually cool off, it will actually bring about a buy call for CapitaLand. Yep. For CapitaLand, the main driving reason is due to their China residential exposure. In 3Q13, they actually reported a very strong financial performance on the back of a very huge contribution from the China residential business. We expect this to continue because their sites are kind of strategically located, and we believe that those sites will sell well in the upcoming 2014. Currently, it's kind of like in full stream. They're really going all in for the China residential before, as the prices are riding kind of high at this point in time. We understand that there are some policy risks starting to creep in the top tier 2 cities, and also the tier 1 cities. The government is kind of like trying to have a hard hand and trying to impact the market in kind of like maybe a slightly adverse manner or whatnot. But we strongly believe that the momentum for CapitaLand China residential is kind of in full stream, full speed ahead, and they should be able to get these units. In terms of unit sales, they should be able to achieve their estimate of 1,000 odd units per quarter going forward, and clearing their book before any drastic changes to the fundamentals for the China residential real estate happens. So yep, this is for the big developers. For the retail and hospitality, our topic still remains as Amara. The key point to note this time around is the fact that their business hotel in Bangkok is actually going to open in 1Q 2014. So in that sense, going forward, you can see that their earnings will actually be better than last year, and in current year earnings is already better than 2012 based on the fact that 100M has really complete, and their hotel and retail at the Amara Singapore location is kind of picking up. So in that sense, 2014 will be the year whereby you can see contribution from Bangkok Hotel, and also the following year 2015 will be Shanghai. So once again, this is kind of like focusing on their growth in terms of their assets and in terms of their cash flow. Yeah, and with that, I come to an end. If there's any question, please do post it under the question column on the webinar program itself. Thank you. Yeah, it's Q&A session right now.
Hi. Okay. First question is this a good time to buy the STI ETF? Okay, to answer this question, I'm going to talk about two ways of looking at it. Okay, the first thing we want to reiterate is that fundamentally, in terms of economic numbers, right, we are actually longer term bullish on the STI. Okay, so that being said, to answer your question, is it a good time to buy the STI ETF? I got to put on my trader hat on, and maybe I'll give you a trading setup. Okay, wait, let me find the chart first. Okay, STI chart is here. Okay, so the trading setup would be like this. Okay, yes, you could buy your STI ETF. However, if price breaks through this blue support here, then you have to sell it. And after you sell it, you have to look at where the next support zone will be before considering if you want to buy it again. So basically, you can buy it now and you hope that it'll be a cycle up. Okay. Now, if this breaks, then you have to sell it when this blue zone gets broken, and you will consider buying it again at the next target, right? And the next support target is basically here, 29.10. So that's what you do. Once again, so if you buy the STI right now, you have to sell it if it breaks through this level, and you can consider rebuying it again if the price actually stabilizes at 29.10. Okay, that's what you do as a trade essentially. Okay, next question is the China ETF that I showed better than the CSI 300? Well, the thing is, this ETF that I showed here, HK83188, this actually proxies the CSI 300. Actually, it's just that it's in Hong Kong. I'm assuming the question you're asking me is versus the CSI 300 ETF in Singapore. I'm assuming that's what you're asking me.
Yep. Hi. There's a question on the NAV and target price for Amara. Our NAV is 123. Our target price is actually at 74 cents. The heavy discount to our NAV for the target price is due to the fact that it's as a first foray into their overseas market. But having said that, even at their current NAV, okay, it's actually higher than their target market price right now. It's about 70 odd cents. So yep, NAV is 70 odd cents. Target price is 74 cents. RNAV is $1.23, just to recap. The next question is actually one of the listeners he read that there's a huge supply of hotel rooms coming into the market to the extent that the RevPAR of hotels are affected. Could it negatively affect the hospitality REITs? And how do he reconcile this with our optimistic outlook on the sector? I agree that there is a sizable supply of hotel rooms coming in, and on the overall, if you're looking at the RevPAR, is going to there would be a slight impact. So I agree to that. But having said that, let's look at the supply more in terms of, let's look at the supply more in depthly among the 14 to 15 hotels in terms of whether it's a new hotel or whether it is coming going through AEI and coming back to the market. The majority of it is actually in the mid-tier segment, and it's like a 3-star, 4-star. So in that sense, that is where the competition is. But having only unilaterally looking at the supply, we're actually overlooking the fact that some of the other mid-tier hotels are actually pulling back. They're actually going through AEI, and you will be able to see this in 2014 when people start to announce that, oh yeah, they're going to go through AEI, and they will not form any part of the market stock anymore. So in terms of the actual number, the net number of supply, the net supply that's coming in is actually not enough to heavily impact the market. And obviously, if you're looking at the hospitality REITs, okay, these guys are the hotel owners that actually actively manage it in terms of marketing, in terms of making sure that the look of the hotel is good, and these guys will not be affected if anything. In fact, I think that the whole overall market, macroeconomic market, actually bodes well for them because they actually look more attractive. So how do you reconcile that? For those that have very new hotels, I think they are in the luxury segment. They're definitely they should do well. For those in the mid-tier segment, those REITs that have hotels in the mid-tier segment, I do believe that they are those active managers. They are those that are more proactive in the term of in terms of intangibles, and they should also see a good year for 2014. In terms of why would the overall sector look a drop in the RevPAR? Most probably is because those as older hotels, okay, they're going to suffer quite a fair bit though. Yep. So I hope that answers the question. And the next question on slide 40. Now just let me just get to that. On slide 40, what does price to book historic average means? Is CapitaLand average of 1.5 better than CapitaLand average of 2.4? Also taking CapitaLand as an illustration, is the price to book current 0.79 the lowest of its PB historic average to 0.9 to 2.5? Okay, on slide 40, when we are just when listing the price to book average out, it just kind of let you know that historically what are their how in terms of like the price to book, what's the historic average like, and just kind of like their valuation. So in that sense, we feel that currently right now the current of 0.79, just trying to illustrate that it's actually at the bottom of its valuation, which means that it's kind of cheap at this point in time. Is CapitaLand average of 1.5 better than CapitaLand? No, we can't really. The comparison for this price to book is not for meant to compare between CapitaLand and CapitaLand. It is more of saying it's more of comparing the history of 1.5 to currently of 0.79 in terms of price to book ratio. Just to illustrate the point that currently all these three, they are actually at the bottom of their valuation. The price to book history of 1.5 is an average over the past 3 to 5 years, and 0.9 to 2.5 is like the range of which it previously. So what's in the bracket is actually the range. I hope that answers your question, Cheryl. Okay, there's a question on what's the PE, ROE, ROA, long-term debt, and debt to equity and debt to equity and debt to equity ratio for Amara. I believe that I will refer you guys to my previous report, and I hope that through the online, through poems and whatnot, you're actually able to tap onto that, and you actually see what are those ratios like. So yeah, I'll just refer you guys to that. If you're unable to find the report, do contact me at my email, and actually forward it to you. Last 4 questions for you.
Okay, just there's a question on TA lesson, technical analysis lessons that some of the viewers wanted to have. Okay, so based on manpower issues, we are planning a series of TA lessons, but the majority of these TA lessons will only occur probably in the second half of next year. So that means basically third quarter. However, on the 3rd week of January, right, I will introduce I will introduce some TA stuff lah, but only very occasionally. So actually this 18th I'll be in the Monday webinar, I'll be taking an extended portion to do a bit more technical analysis. Yeah, so so on the 3rd week of January I'll be doing that, but the actual TA lesson will be on the 3rd quarter of next year. My apologies for not being able to do it earlier because of manpower issues, and we do want to do a good job for you. Yep.
All right. There's a question on REITs asking how much do you think the REITs will fall when the tapering starts, or has it already been priced in? Currently, if you guys were to look at the current futures for I think currently all the different 5-year, 10-year, and 1 month, 3 months, all the interest, the government securities, you can see that they actually have already sort of like predict that there will be a rising interest rate, and it's kind of pricing in that sense. However, when the QE tapering starts, the outlook for interest rate may also turn a bit more adverse. So in that sense, has it been priced in fully? The answer, my answer for that is actually no for the REITs, based on the current price movement and also the fact that how the interest rate has moved currently. So I do not think it has been priced in fully. How much will it drop further? Is kind of, it depends on individual REITs per se. I can't really say that there's a quantitative answer to that. But having said that, we had to acknowledge the fact that this REITs are actually facing quite a grim outlook, because when the interest rate forecast, when the QE tapering starts, the outlook will also worsen, and in that sense, the price may fall on that. Yep. So I would much rather you guys try to look at the REITs who are actually going through announcing all their acquisition or having strong cash, net cash positions, and then they are able to go in for more assets and whatnot, because those growth may and should outweigh the downward effect of the increasing interest rate. Yep.
Okay, there's a good question here. How does the analysis of the Dow Jones Index and sector rotation models help in the analysis of the STI and the stocks listed here? Now that's a very good question, and there are actually multiple reasons. Okay, one, the thing is, we note that the US market is basically the biggest market in the entire world. Okay, the US also takes up the biggest GDP by country, and because of this, right, the companies in the US essentially is a big proxy to the world economy, because most of their companies, especially on the Dow Jones Index, are all multinationals that basically have operations worldwide. So when we can see the behavior of different sets of companies in the US, that gives you an idea of which sectors globally are doing well. And at the same time, you will also note that the STI does have a positive correlation with the Dow Jones Index. By and large, when the Dow Jones goes up for an extended amount of time, so does the STI. And when the Dow Jones Index goes down for an extended amount of time, so does the STI as well. So because of this positive correlation, plus the fact that the US market is quite very correlated to world economy, that gives us good reasons to look at the Dow Jones Index, even if you're only interested in the STI. Another reason is also, don't forget about relative valuations, meaning because US is a very big market and it's a universal market, people from every country can invest in the US. So because of that, if the US prices actually come down, just by the fact that the US companies are cheaper, there will be people that will sell off their stocks in the Singapore or emerging markets to buy US stocks, because you can see it's an arbitrage, so to speak. So if the US stocks go down, because these are easily tradable, it will cause money to flow out of other areas as well. So those are 3 to 4 reasons why we look at the Dow Jones Index. Yeah, and also because at the same time, because the Dow Jones Index, or rather the US Index, right? When we do sector analysis for these sectors, we can see it's a better proxy of the economy because of the number of counters that they have and the scope of their counters. Yes, so that's why we do sector rotation in the US market. Doing sector rotation in the Singapore market is actually not as useful because of the number of stocks that we have in the index, and the nature of our companies, the nature of it is not as widespread as well. So doing a sector rotation presupposes where you are on the economic cycle, and the Singapore market is not a good proxy for that. Hence, we look at the US market. Okay, what is the short-term house view of Shanghai market trend? Our short-term house view is that we are actually bullish on the Shanghai market. For a few months now, we already think that, especially now with the third plenum, that the Shanghai market has taken a turn for the better. We believe that this is most likely a double bottom, which implies that price should either go sideways from now or actually go up. So we think this is bottomed out. So on the short term, as I said, right now, it's a good sign that price last week had actually broken through this downtrend line. This is a multi-year trend line. It's a good sign. And as long as we can stay above this trend line, okay, and especially if we break 2260, if we break this, then this is bullish on the short term. And the short-term target is actually here, 24 to 2500. Of course, we are hoping that it will break through that as well, but we won't look that far. We'll just say the short-term target is between 24 and 2500. Question: what is the difference between cyclicals and non-cyclicals? Cyclicals essentially are economically sensitive stocks that do well or do badly depending on the economic cycle itself. And non-cyclicals, another name for that would be your defensive companies that tend to be not so seasonal. They tend to have the same type of performance regardless of the economic cycle. So, for example, non-cyclical defensive stocks, an example of that in the US market would probably be things like Coca-Cola, your F&Bs, things like that. These are because consumers drink and use all these Johnson and Johnsons. People will buy all these products whether or not you're in a depression or recession or not. Okay, but then cyclical companies would be the offensive ones, like for example your oil and gas companies, because when the economy is bad and the price of oil drops down, these companies all will make less money. But at the same time, when the economy starts doing well and price of oil starts going up, these companies also do much better as well. Yeah, so that's the difference. Can you name good pick on cyclical STIs? Example of cyclical companies on STI that our house actually covers and we recommend will be companies like Keppel Corp, Ezion, Penn United. Yeah, basically your oil and gas companies and your industrials. Am I missing anything? Okay. Yeah, sorry I missed out one. Yeah, and Sinheng heavy industry, heavy machinery. Yeah, which is a proxy basically on the Southeast Asia infrastructure play.
Alright, it's back to me again. Alright, the question here. REIT growth requires loans, and if interest rate rise, wouldn't acquisition be detrimental to REITs? The truth about it is in Singapore REITs, a lot of them actually have all their interest hedges in place already. As and when they borrow it, they actually goes a little bit into kind of like a derivative kind of thing, whereby they actually hedge their outlook over the next 2 to 3 years. I think in my previous presentation, I actually did a summary, and there's about 60 to 70% of all the loans that they have taken. That's about 60 to 70% is all hedged. So in terms of exposure right now, if they were acquired today, I don't think that that's an issue. It's more like a time bomb. If let's say they have not acquired, but when a QE tapering starts, then that will actually be a red flag for that counter. So if they acquire right now and their interest rate is in place, I don't think that would be detrimental. But once again, we have to look at individual acquisition, individual deals, and how do they structure the acquisition to actually make a comment on that. This is like a kind of a general outlook. Another question: among new hotel in Bangkok can be affected by a political crisis, right? I won't want to never say never. I would never want to come to a point of saying that they're 100% unaffected. But I believe that by the time they launch and in the long term, I don't think that they will be affected by the political crisis. But having said that, we actually, when doing the valuation for this counter, we actually put a very heavy discount cap rate, a very high cap rate and very heavy discount rate on valuing this asset of theirs. So we believe that has more or less been built into the valuation.
Based on all of them are cyclical, but some are more cyclical than others. REITs are because all cyclical, but some are more than others.
Then you answer
it. Okay, question: are REITs considered cyclicals or not? Okay, basically all REITs, by the nature of the investment, right, property plus leverage, they are all cyclical, but some REITs are more cyclical than others. Depending on the sector, some are more cyclical. So obviously the retail REITs are less cyclical because everyone needs to shop retail buys. But then things like office REITs, industrial REITs, these are more cyclical. But at the same time being said, because all REITs are interest rate quite affected by interest rates quite significantly, that makes it cyclical. Because in the business cycle, interest rates will vary, right? In the business cycle itself. So yes, so once again I reiterate, all REITs are cyclical because they are interest rate sensitive, also property sensitive obviously, but some are more than others based on the sector.
Hi, a question on top picks. What should we buy right now? I think in terms of looking at our coverage, the ones which we have more conviction on right now is DBS and Bousted. I will go through Bousted, and my colleague Ben will go through DBS. For Bousted, it has performed very well this year already. It's up by 70%. However, I do personally believe that it can go to over $2, and my price target is $2.05. It's had a strong move in the last few weeks and then corrected, right? It hit 180 and it's corrected now to 160. And I think at 160 there is a room for accumulation. Now, why am I positive on Bousted? It's because order books are at a record high, and most of the earnings there will be booked over the next 2 years. Also, its industrial portfolio is going to expand by about 60%. That will bring in more recurring income, and there is also plans to REIT the portfolio, and that provides a catalyst. And then there's a further catalyst in its rather large development in Iskandar, Malaysia, a joint venture with Tat Hong and a Malaysian player. And basically, I think there is no fixed plot ratio in Malaysia. That is subject to authorities' approval, and there could be a very significant development from there. Further question that has just come in is about a cyclical stock. It is cyclical, yes, in some parts. So the cyclical elements would be its energy division is definitely cyclical. Its water division is definitely cyclical. However, what's not cyclical is the geospatial technology is non-cyclical. That depends mainly on a secular trend, which is basically data-driven decision-making at the governmental levels. But it has, like I mentioned, catalysts ahead, right? Which is basically REITing the portfolio, and also I think basically the new development in Iskandar. Right, I'll put you now to Ben. Oh, okay. Further question is, will Bousted be impacted by an interest rate hike? I would say it would be impacted in the sense that, let's say it does plan to REIT the portfolio, but it is REITing it in, if it does do it in 2015, which is what we think will be the start of the interest rate cycle, then I think it will REIT the portfolio at a lower valuation, right? Because interest rates go higher. However, it has about 1 year ahead to do so.
Hi everyone, it's Ben here. So we're just giving you 3 quick reasons on why DBS remains our top pick. So first of all, on our home front, the Singapore macro data is holding up pretty well. We're into 2014. So as banks are pretty good proxy for GDP growth, this remains quite a good upside factor for us to remain overweight on our banking sector. So secondly, in terms of DBS, it has the strongest foothold to Greater China through Hong Kong. And as China's economic data is holding up pretty well, we expect trade flow to remain strong to ASEAN. And as DBS has been gaining pretty good traction in terms of their trade finance fees and commission, the positive outlook that we have on China definitely will allow DBS to gain the most in terms of the growth in their fees and commission. So for the last factor, for the QE tapering in US, so if QE tapering does happen, we expect our interest rates to rise. So because of this, we do expect that DBS will tend to gain the most when interest rates rise, probably, I would say, during the second half of 2014, because of their cheapest. They have the cheapest funding base as they have the highest current accounts and saving accounts balances. So in comparison, OCBC, on the other hand, could stand to be the most volatile in terms of their earnings because of their Great Eastern subsidiary, where the rising interest rates will take a negative impact on their non-participating funds, as we have seen during the first half of 2013. So in terms of valuation-wise, DBS currently still remains the cheapest, as it's trading at lowest PB in comparison to the other two banks, and that is why DBS remains our top pick.
Hi, a question that says the Dow Jones Index, sorry, it's Ken here. So anyway, the Dow Jones Index is only 30 stocks. Wouldn't S&P be a better proxy? Yes, we agree. S&P would be a better proxy, and that's why we use the S&P actually in our analysis. Actually, I used the S&P for the chart, and I used the New York Stock Exchange for breadth. And the New York Stock Exchange consists of all the stocks on the New York Stock Exchange. I only mentioned Dow Jones Index because somebody asked in the question about the Dow Jones Index. So yes, I agree that the Dow Jones only has 30 stocks, and S&P is a better proxy, and that's what we've been using. Okay, next question is, compared to Keppel Corp and Sam Marine, can we have a good pick among these two? What is the target? Okay, so according to our O&M specialist, who is not here today, he favors Keppel Corp over Sam Marine, and he would recommend that over Sam Marine at this price. This one. Can I just answer this? Okay, another question. Can I say healthcare REIT are the most non-cyclical? And we agree that in the REIT universe, the healthcare REIT would be the most non-cyclical because the healthcare sector is a defensive sector, which depends more on demographics and the aging population rather than the world economic cycle. But the REIT aspect to it makes it a little bit more cyclical. But yes, it is the least cyclical of all the REITs.
Hi, this is Colin here. Earlier, we have missed out as one of our top pick stock also includes M1, which is our favorite preferred stock for the telcos. Okay, M1 basically we expect good traction on its mobile revenue as we still continue to see more subscriber exceeding their data allowance, and also the take up in the 4G plans is also still has a healthy take up rate. So, and with the recent increase in the excess data charges recently announced by M1, which will take effect in 2014, so we believe that this will allow further growth for its mobile revenue. Also, M1 is also gaining in terms of its fiber broadband space as they are growing their fiber broadband customers from a low base. Also like to add on that is net debt to EBITDA is at an all-time low for over the past 3 years, so this may potentially increase the probability of them increasing their dividends in 2014.
Right, guys, we have come to the end. Today, presenting analyst is Kenneth Cole. If there's any question on those, please email him for it. And the presenting analyst for the property sector is me, Lucas. My email is tnsj@phillip.com.sg. Yep, so if there's any further questions or you guys want to seek clarifications, yep, do contact us. All right, that's all. Thank you.